To quote Omar Little from The Wire, you come at the king, you best not miss. I don't intend to. World famous investors like Charlie Munger and Jack Bogle are wrong about things like alternative asset classes and factor investing, which is sometimes called smart beta. They're wrong. It's not ambiguous. The evidence is clear.
I'd go further. I'd say averaged out, I would expect that the return per dollar per year in managed futures funds would be somewhere between lousy and negative.
If smart beta is winning, dumb beta is losing by the exact same amount. And there's no way around this in the marketplace. If strategy A works for investor A, then strategy A will not work for strategy B will not work for investor B.
But how can investors this intelligent and successful be so wrong about something so fundamental? Well, it has to do with their understanding, or rather misunderstanding, of what the market is and what it even means to capture its returns. And this is an area where academic finance and research has greatly increased our knowledge in recent years. Let me explain. But first, a quick disclaimer. I'm not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. So let me begin by saying I think Jack Bogle was right about what actually matters, the essential principle, his approach to investing overall. Not partly right, right about the thing that matters most. Don't try to pick individual winners. Don't pay someone to pick them for you. Own broadly. Keep costs to the floor, at least insofar as you can, based on what asset class you're investing in, and let compounding do the work for you over time. That idea has made ordinary investors wealthier than almost any other concept in modern finance. So this is not a takedown video. My disagreement is narrower and more nuanced than that. I believe Bogle didn't follow his own principle all the way. That's it in a nutshell. He gave us the right philosophy and then handed us an execution that quietly violates it in several important ways. The S&P 500 or a total market fund like VTI gets sold as just buy the whole market. And see, calling VTI a total market fund is part of the problem because it's actually just a different philosophical take on US large caps. There's really not that much of a meaningful difference between it and the S&P 500. It just isn't the whole market. It's a bet on one weighting rule in one asset class, namely large caps, in one country, the United States. And as I'll show, it captures only one of the several drivers of equity return we now understand. I'll make that case with the verified academic record and then show you what a fuller, more faithful execution looks like, deliberately harvesting the factors Bogle's own rule leaves on the table, across asset classes, and all held together by disciplined and very simple rebalancing rules. So after this presentation, I am going to show you my personal portfolio, the Atlas portfolio, and how it executes this extension of Bogle's essential philosophy. So let's start with the phrase itself. Buy the market. Okay, which market? This is one of the oldest results in asset pricing. In 1977, Richard Roll published what's now called Roll's Critique in the Journal of Financial Economics. The true market portfolio, the thing our theories refer to, contains every asset that has value, weighted by that value. Public stocks, real estate, commodities, private businesses, bonds of every kind, even human capital. You name it. And that portfolio is unobservable, partly because, well, how do you define value? You can't buy this portfolio. You can't even measure it in a way that everybody agrees on. So every index is a proxy, and equity indices are very rough proxies. Roll aimed this at academics using the CAPM, but it lands just as hard on the index investor. When someone says VTI is the market, what they mean is US public equity, and particularly large cap US public equity. And that's a meaningful slice, defined by market cap weighting, which has its own limitations, but it's still a slice. And I really want to focus on that word proxy. Since no index is the true market, the honest question isn't which single index is the market, but which combination of exposures best approximates it, or at least best approximates the slices that I want to have exposure to. Um, you know, because my strategy is to have uncorrelated slices of that wider market that move in different ways and compensate for each other when one part of the portfolio is drawing down, having another part going up. That reframing is the hinge of everything that follows that I'm going to talk about today. You might say, fine, it's stocks. But at least within stocks, cap weighting is neutral. And hey, the US is great. And I agree with that. But I want to push hard on neutral. Market cap weighting is a rule. It's a strategic choice. It's not just something passive, even though that's the name that's been attached to it. It weights by price, so as a stock rises, its weight rises with it. It never trims a winner. That's pro-cyclical, trend-following characteristics baked into the basic design here. It's a form of momentum, in my opinion. And hey, I'm not opposed to trend following or momentum. I mean, just look at the name of my channel. And you can watch it concentrate these indices. As a bull market narrows to a few names, the top 10 holdings swell, and the total market fund becomes a mega cap wager. And this happens again and again. Ben Johnson's 2020 Morningstar analysis shows exactly this. Is it a good thing? Is it a bad thing? No, it's just a thing that happens to be aware of. Now, the crucial precise part, and it actually strengthens my argument, this structural momentum is not the academic momentum factor. If you regress a total market fund on the formal Jagadish-Titman momentum factor, the loading is basically zero. You can try it out for yourself. So here's the thing. Cap weighting hands you pro-cyclical concentration, but not the compensated momentum premium. The factor exposure that would pay you for trend is simply absent in broad market index funds. You carry the concentration risk, you don't collect the factor return because you don't actually hold the factor. If you actually want momentum's return, you have to harvest it deliberately. With traditional equity indexing, you bear the trend following exposure and don't get paid the factor return for it. You just get paid the market beta because winners aren't turned over once their momentum stalls out. That is the worst of both worlds in my view. If you actually want momentum's return, you have to harvest it, right? But Bogle isn't only betting on a factor, call it the market or market cap factor. He makes a bet on another axis, geography. So at the end of 2024, the United States hit a record, approximately 50% of global equity market capitalization. But it's only about a quarter, roughly 26% of global GDP. I'm comparing market cap to output, not to population here, because that's the more honest comparison. Market cap should track what economies produce, and here half the world's equity value sits in a country that generates only about a quarter of world output. And hey, maybe that premium is justified. American companies are extraordinary, but recognize what you're doing when you buy the S&P 500 or a VTI ETF. It's a concentrated bet that this one country keeps dominating. And Bogle didn't hedge that bet, he amplified it. He kept telling US investors repeatedly that they don't need to own international stocks at all, really, because international coverage is covered by multinational corporations, or at the very most to keep it under 20%. And his orthodoxy doesn't just accept this single country concentration, it just keeps on positively recommending it, even though Vanguard has nuanced its position overall. But even VT, the global solution, doesn't escape this. A total world fund like VT is still around 60 plus percent US and heavily large cap. So whether you buy the US index or the world index, you're buying in the main US mega caps or mega multinational companies. And besides, broad equity indices, especially in large caps, have become increasingly correlated partly due to those multinational companies. So, buy the market has quietly become bet on American or at least international large and mega cap companies. And that may keep working, but it's a view, not the absence of a view. It's the owning of a single asset class. And notice it's also, once again, almost pure large cap blend beta. So these indices say that they're total market, but if you regress on their loads, there's barely any small value or momentum exposure whatsoever. The concentration hides the fact that you're under owning the very slices that have paid a premium and continue to do so, especially momentum in recent years. I mean, most of the market growth comes from the smaller players because they're earlier in their journey. They grow faster, just like kids do. Whereas most of these indices, because they are market cap constructed, you're only getting growth from adults. Well, you're underweighting all of the kids. And the universe is also far broader than public stocks and public bonds. I mean, I know that people like Warren Buffett say they'd rather own businesses than own what businesses own, but, you know, gold, commodities, real assets, and non traditional bonds like catastrophe bonds, cat bonds, where you're paid a premium to bear hurricane, earthquake, and other risk. Heck, even farmland is a great asset class, though it's terribly difficult for retail investors to own. Bogle dismissed most of this. On commodities, he was blunt. The expected internal rate of return is zero, so to him, commodities are just speculation. There's a point there for a standalone bet, but it misses the portfolio point, right? Take cat bonds. Their returns are driven by natural disasters, not the economic cycle, so they carry roughly zero point 0.2 correlation to stocks and bonds, and they held up in 2008 and 2020 when everything else fell together. And a similar argument applies to commodities during inflationary periods. You're not holding them to really get rich. You're holding them so that they raise when everything else is falling, and then you can sell them and buy other assets at the bottom through rebalancing. That's exactly the uncorrelated return stream a faithful own everything philosophy should want. And as we'll see, uncorrelated streams are the raw material for the rebalancing engine at the end of my talk here, namely my own Atlas portfolio. There's one more crack in the index everything execution that Bogle did that I want to tackle here. For stocks, weighting by market value means you own more of the more successful companies in general, and that's reasonable. But a bond index weights by the amount of debt outstanding. The more an issuer borrows, the bigger its weight is in your fund. You systematically lend the most to the biggest borrowers. Practitioners call this the quote unquote bums problem. Arnott and co authors laid it out in 2010, and Larry Siegel has written on it for years. And the bond market is enormous, over the counter, and diffuse. So market beta is a much fuzzier idea there. This is a place where thoughtful, active, or fundamentally weighted approaches have a real defensible case, which is kind of awkward for a philosophy built on indexing everything. Anyway, enough about bonds. Bogle was focused on equities primarily, so we'll keep focused on that for now and leave bonds for a future video. Here's the irony. Bogle's method benefits from a structural trend tilt that we talked about, from letting winners run. Yet he was, to the end, a flat opponent of factor thinking. In 2018, he told Morningstar's Christine Benz, I don't believe in factor investing. And on a podcast that same year, his verdict on smart beta was 4 words. Smart beta is stupid. Actually, I think that was from a 2017 podcast, if memory serves. Smart beta, by the way, is his term and an older terminology for equity factors, Fama French factors, and other ones besides. Now, Rick Ferri carried that skepticism forward more carefully. On the long view in 2019, he granted that value and size are real premia. His worry was capturing them net of costs and human impatience. Factor renters, not owners. So he was worried that people might not hold them long enough or the premium might not overcome the fees. And here's another point where I part company with Boglehead orthodoxy. Ferri's point is solid, but I think it's an argument for discipline, not for abandonment. And he's wrong about fees. They're actually lower than expected in real-world environments. The behavioral gap he describes, people chasing and bailing, is a reason to hold factors through their droughts, exactly as Bogleheads are told to hold the market through its crashes. And I don't even know why the S&P 500 is used as such a be-all, end-all index everywhere, because ultimately it is just another asset class to hold. So why is holding the S&P 500 from 2000 to 2010 any more difficult in principle than holding small cap value from 2011 to 2020? I mean, other than the fact that there's a lot of people out there holding out a chart of the S&P 500 saying you should be doing at least this good. Why? Were they holding up that chart from 2000 to 2010 saying you should be doing at least this bad? That doesn't make sense. Trying to measure everything against the S&P 500 would be like trying to measure everything against gold. It just doesn't work. So none of this is evidence that premia aren't there. The premia are there. Value, size, momentum, profitability, and so forth. And they're persistent across a century of data and pervasive across dozens of countries and asset classes. So what if they don't show up all the time? Well, neither does the S&P 500. That's not my opinion. It's the evidence-based case that Paul Merriman, Ben Felix, and Larry Swedroe have each built careers on. Bogle rejected the very model that explains, and in my opinion could improve, his own results. Market beta, the return of the whole stock market over cash when you cap weight it, is just one driver of return. It is just one dimension of a market. It is not the only one. Fama and French showed in 1993 that size and value explain a large share of the differences in returns across portfolios. And in 2015, they extended that to profitability and investment. Jagadish and Titman documented momentum in 1993. And Carhart made it the fourth factor in a 1997 paper in a variant market return model. Birkin and Swedroe distilled 100+ papers into 5 tests a factor must pass to be worth owning. It must be persistent across time, persistent across countries and asset classes, robust to definition, investable after costs, and intuitive. Value, size, momentum, investment, and profitability all clear that bar. Here's the framing I want you to take away. These factors, used to identify different groups of stocks, are effectively different asset classes within equities. Value stocks and momentum stocks can be as different from each other in their return behavior as stocks are from bonds. And a cap-weighted total market fund holds so little deliberate exposure to any of them, as Paul Merriman puts it, it has no impact on your outcome at all. Buying the S&P 500 is buying one asset class, one factor, market cap beta, and calling it the market. Calling it the market even though you're only owning US large cap. The full model says the market is way bigger than that, and Bogle just isn't capturing all of it. Now, the sharpest tool in my toolbox here, and the heart of my positive case for my own investment strategies, is this. Value means buying what's cheap. Momentum means buying what's trending up. On the surface, they sound contradictory, and that's exactly why they're so powerful together. In Value and Momentum Everywhere, Asness, Moskowitz, and Peterson showed across US, UK, European, and Japanese stocks and across bonds, currencies, and commodities that both premia are real and, critically, that value and momentum are negatively correlated with each other. When value is having a bad stretch, momentum tends to be having a good one, and vice versa. Now, assemble it. Roll told us the true market is unobservable, right? So the honest move isn't to pretend one index is everything, or that you could even create an index that owns everything. It's to approximate the dynamics of that market with the broadest set of low correlation return streams you can reach. And there are two layers. Within equities, deliberate value and momentum sleeves, with other factors used to support them, plus small and ex-US across asset classes, real assets, commodities, differentiated bonds, uncorrelated premia, like cat bonds. So you've got your equities, you split them up by factors, you make sure that you're globally diversified, and then you bring in so-called alternative asset classes, not as satellite holdings, but as core parts of a strategy. When you hold genuinely uncorrelated, or better, occasionally negatively correlated, like managed futures, assets, and rebalance them, you harvest a diversification return. The rebalancing bonus, and it's sometimes called Shannon's Demon, after Claude Shannon, and I've done a video about that. You should definitely check it out. Booth and Fama named and formalized it in 1992, calling it the diversification return. Yes, the same Fama of the factor models, after Fernholz and Shea proved the mechanism in 1982. Volatility, usually pure risk, and considered kind of a bad thing, becomes a source of growth under this model. And notice how the pieces lock together here. Value and momentum are occasionally negatively correlated, especially when one is under stress, which is precisely the raw material that this engine runs on. Rebalancing them mechanically sells the one that's run up and buys the one that's lagged. This is Markowitz's so-called free lunch made concrete. Not stock picking, not market timing. Disciplined rebalancing across genuinely different return streams and viewing volatility itself as part of the market. Though, discipline really isn't a free lunch, is it? It's quite hard. Let me stop and take the hardest shots at this argument I've presented, because maybe you're already thinking them. Here's 3 serious objections to factor investing and asset class diversification. So first, the strongest. Factors are dead, arbitraged away after everyone knew about them. The honest answer is this is only partly true, and I have a video about premia decay, and it doesn't sink the case. McLean and Pontiff studied 97 published predictors and found returns about 26% lower out of sample and 58% lower after publication. So, publication and making people aware of these factors does shrink premia. Sophisticated traders compete some of it away. That's true. But the crucial finding here is that the post publication return is statistically different from both 0 and 100%. It shrinks, it doesn't vanish. And value specifically, its miserable 2010s weren't the premium disappearing. They were value stocks getting relentlessly cheaper relative to growth, a widening valuation spread. When that snapped back a little bit in 2021 and 2022, value had one of its best stretches in decades. A factor getting cheaper is not a factor dying. It raises its expected future return, right? And once momentum crashes in the next market downturn, you can guarantee a lot of people will exit momentum, and suddenly that factor resets like a coiled spring. Second, here's a second objection here. It's just data mining. Torture the data enough and you'll find any pattern, right? Well, the defeater for data mining here is out of sample evidence, and that's exactly what value and momentum have. Asness, Moskowitz, and Peterson, they all found premia in UK, European, and Japanese stocks and in bonds, currencies, and commodities. Markets the original US stock studies never touched. Harvey, Liu, and Zhu deliberately raised the statistical bar to clear out the factor zoo, and, well, value and momentum are among the few that survive it. Data mining cannot fake out of sample pervasiveness across 8 different asset classes and geographies. So, a third objection: costs and taxes eat the premium. This is Ferry's factor renter problem. So, Frazzini, Israel, and Moskowitz answered this with roughly $1 trillion of live institutional trades across 20 plus markets. Real world trading costs are about a tenth of the textbook estimates skeptics were quoting. And value and momentum survive net of costs and scale to tens of billions. I mean, anybody paying attention to the performance of SPMO can realize this. And you're not paying 1990s active fees to get this kind of return either. Avantis and DFA deliver these tilts for a few more basis points than other low-cost index funds. I mean, the costs are real, they're just far smaller than the objection assumes here. Now, I want to address the objection to broadening beyond US large cap, because I know there are a lot of really intelligent people who are very committed to investing in only US equities. And there are arguments to be made for that. But ultimately, I don't find them compelling. First, though, the big one, right? The S&P 500 has crushed everything for 15 years. Why diversify away from the winner? Well, there's two answers here. One, a large share of that outperformance came from rising valuations, U.S. multiples expanding. Not purely superior earnings, and multiple expansion is exactly what doesn't repeat forever, right? I mentioned before, U.S. equities make up in excess of 50% of market cap. I mean, VT is 60% US, but GDP is only 26%. So does that mean that US stocks are twice as expensive as they're supposed to be? I don't know. That's a valid question. But second objection I want to tackle here is recency. So from 2000 to 2009, the lost decade, the S&P 500 returned roughly zero, while diversified and international portfolios did fine. Anyone who diversified away from US large cap in 1999 looked foolish for about a year and then vindicated for the next 9. Concentration in the recent winter is the bet. Diversification is the hedge against being wrong about which decade you're standing in. And that's why I like portfolios that stretch themselves out across different asset classes, because you don't know when one asset class is going to win or when it's going to lose. And I don't like putting all my eggs in one basket, even if that basket is the S&P 500 or the global stock market fund. Second objection, though, this is too complex, right? I'll lose discipline and I'll bail during a bad stretch. And that's a real risk, and I won't wave that away. It's Ferry's point again. But the answer here is the same discipline that Bogle demanded, plus rules-based rebalancing that can run on autopilot. And it does not require complexity. Paul Merriman's worldwide four-fund portfolio, for example, or Ben Felix's model, is a handful of low-cost ETFs and one annual rebalance. Simplicity and factor exposure are not in conflict, and I tackle this head on my channel. I also think that it's a little bit disingenuous to say people might shy away from holding a broad basket of things because they're underperforming the S&P 500 without really confronting the fact that people can get spooked into selling the S&P 500 or VT at the bottom as well. I mean, just look what happened during the dot-com bomb or the great financial crisis. And it's not a question of if, it's a question of when the S&P 500 is just going to have a bad 20 or 30-year stretch. That happens. But it's kind of weird because I don't see people going around holding up VBR as the superior index, but people do that with the S&P 500. It's brilliant branding and marketing. Third objection. Isn't tilting just active management, market timing in a costume? Well, no, and the distinction matters. Market timing means forecasting, getting in and out on a view. Factor tilting is actually the exact opposite. It's fixed, rules-based exposure you hold through everything. No prediction involved. And keep in mind, cap weighting is itself a rule. A momentum rule, I'd argue. Everyone is running a systematic rule. The only question is whether yours captures the compensated premia or leaves them on the table. Choosing a better rule isn't timing the market. It's engineering. It's good portfolio design. Before I finish, I have to take on Bogle's single best argument, in my opinion, the one that opens his little book. The Gotrocks family owns every stock in America, so together they collect every dividend and all the earnings growth. They're winning. Then, one day, the helpers show up. Brokers, managers, consultants, and persuade some cousins they can beat the others. Everyone trades, everyone pays fees and taxes, and the family's share of its own pie shrinks from 100% down towards 60%. The old uncle's fix: fire the helpers, hold everything, sit still. Buffett's moral is returns decrease as motion increases. And yes, Bogle actually quoted this from a letter from Berkshire Hathaway, so it's kind of Buffett's parable too. And this is just Sharpe's arithmetic in a folksy costume. And as far as it goes, it's actually completely correct. So let me be clear. I want to concede this parable entirely. In aggregate, investors earn the market minus costs. Trying to outtrade the other family members is zero sum before fees and a loser's game after. Everything I'm proposing keeps that. Rock bottom cost, well, relative to asset class, because there's no way you're getting into cat bonds with just a few basis points. No stock picking, no manager chasing. I'm not asking you to hire the helpers, and I don't hire the helpers. The trick here is recognizing what the full market actually is, and a market cap weighted index is not, in my view, the full market. And here's what the parable quietly assumes and never argues: that the pie is US cap weighted stocks. I mean, look at its own logic. Own everything, reap all of it, minimize cost. Taken seriously, that's an argument for the broadest ownership you can reach. Global, across asset classes, across every compensated factor. The truly faithful Gotrocks family doesn't own the S&P 500 or even VT. It owns Roll's whole market portfolio, the one we talked about earlier in the presentation. Bogle's own moral points past the S&P 500, not at it. And a deliberate factor tilt is not a helper. It forecasts nothing, picks no stocks, hires no manager, and costs a few more basis points than usual at Avantis or DFA. The premium it targets isn't skimmed out of Cousin Fred's pocket in a zero sum shuffle. It's compensation for bearing a different systematic risk. That's the distinction the parable never draws here. Beta you're paid to hold is not the same as alpha you pay helpers to chase. Gotrocks demolishes the second. It has nothing to say about the first. And my strategy is not breaking Bogle's rule here. It's just applying it to slices of a much bigger pie. So let me bring it all home here. The standard defense is that cap weighting stocks is the neutral default and everything else is the active bet. But cap weighting is only neutral inside a universe you've already chosen. And it's only neutral if you're taking into account the different risk factors involved in that universe. Within US large cap, holding names at their weights is for the most part neutral. But choosing US large cap blend equity as your whole universe, excluding or at least minimizing value, momentum, small, XUS, and other asset classes, that choice is actually an active bet. And it's made before cap weighting ever enters the room. Owning only market beta isn't neutral. It's leaving 3 or 4 compensated premia on the table. The insight was never buy the S&P 500 from Bogle. The idea I think we should take away from Bogle is don't bet on picking individual winners. Own everything you can as cheaply as you can and stay disciplined. So I keep everything Bogle got right. Low costs relative to asset class, discipline, no single stock picking, except if you do it with fund money in a separate account, like I occasionally do. Hey, as Larry Swedroe says, sometimes you gotta send a little. But anyway, no market timing, and you add rules based rebalancing on top of it. Then extend it the way Bogle's own logic demands across factors, across asset classes, across geographies, capturing uncorrelated slices of the full model of returns rather than one slice of one country. That's not a rejection of Bogle. In my opinion, it's completing his philosophy. And this brings me to why I don't do equities only portfolios myself, except maybe the Nader portfolio. I might someday run that in a taxable brokerage account simply because of tax savings, especially if I'm going to let it grow for a while, since my main investments are elsewhere and not at risk of a 60% drawdown like most equities only investors put up with. No, by owning uncorrelated slices of the whole market beyond US stocks and bonds, I can get competitive returns to an equities only investor at a much better risk. How? Because I own parts of the market that move in different directions from each other, complementary directions. Let me show you with my own Atlas portfolio. To get a fair assessment, I wanted to look back at least 50 years of history. And as you well know, AVGV, GDE, DBMF, CBYYX, they don't extend back that far. So here's how I constructed the backtest. For AVGV, I constructed its backtest back about 30 years using the same methodology that I did in the AVGV video for it. So basically, just substituting dimensional funds for the Avantis funds, since their methodologies are nearly identical. Beyond that, I used the equivalent Vanguard indices for value for the US equity portion of AVGV. And for the international portion, I just used VXUS, that index. So beyond about 30 years, AVGV is actually diluted because its international sleeve, it isn't value tilted at all. So that's important to note in this back test. The strategy is actually diluted, which is going to give us a more conservative estimate of how it does. For GDE, testful.io already has that back tested all the way back, more than 50 years. It's not that hard to take the price of gold and the price of the S&P 500 and slap them together, 90%, 90% with 10% cash collateral, and then just plug in the borrowing rate. So that's easy to do. DBMF, it goes back to about the year 2000. It is an index, or at least index like, in that it replicates the average returns of the managed futures space as defined by the SocGen CTA index. So, two approaches to that. The first approach is just backfill with cash for the prehistory before DBMF's index is available. The second approach that I did was I took a Monte Carlo simulation over what is available for DBMF and extended it back 50 years. So, generated kind of 50 years of a random reshuffling of its returns. So again, that's going to give a conservative estimate because although DBMF will remain uncorrelated from other sleeves in the portfolio, it's not going to move inversely to the stocks or respond to the actual conditions. So you're just going to get the non-correlated function of it. I did something similar with CBYYX. So the Swiss Re Cat Bond Index goes back to the early aughts. So what I did there is I looked at CBYYX. It's a pure cat bond fund. I noticed that when you hit Swiss Re, the index um, with the same fee that the fund has, it actually lines up remarkably well. In fact, let me just show you that real quick here before I do any of the other back tests. So here's Swiss Re. The cost of CBYYX is going to be about 1.48. So just put those down there, back test it, and then I'll just X out all the other funds except Swiss Re and CBYYX. You could see how the shape is real cool. Except I need to take the additional drag off of CBYYX there since it's already charging that fund. So as you can see, when you apply CBYYX's cost to the Swiss Re index, of course, Swiss Re is only taken monthly, but look and see how nicely that lines up. I mean, CBYYX might as well be a index fund, and you see this a lot with cat bond funds because a lot of them are very well diversified. So if you hit the index with the fund fee, then it usually collapses to the fund in question. Um, and CBYYX is a good one for that. So that's what I did to extend CBYYX back to about the year 2000. Beyond that, I used a Monte Carlo simulation and just randomly shuffled the returns for a 50-year back test there. Again, getting uncorrelated. It's not actually lined up with disasters as they actually happened in the past, but it gives us a good approximation. And my argument here is that the real returns can be reasonably assumed to be at least somewhere between an Atlas portfolio back test where we just use cash before we have available history for the funds, and an Atlas portfolio back test where we use those simulated extensions in the past. And again, both of these have a diluted global value sleeve, AVGV, because beyond a certain point, it's just using VX US SIM. So keep that in mind, and let's see what we get. And it's loading, backtest complete. All right, so first thing you want to note here is the Atlas portfolio backtest happened to win. Now, that is, we're not trying to beat the market. We're trying to get uncorrelated slices of it so that we can have better risk adjusted returns and absolute returns comparable to a full equity portfolio. And that's what we've got here. So even with the cash prehistory, it's still outperforming the total world market. And with the conservative estimate of those uncorrelated sleeves with the just random reshuffle of returns, it's beating both the total world market and total US market. Why? Because, well, the total US market is actually US large cap, and the total world market is global large cap, which is dominated by US large cap for most of the past 50 years. So we've got portfolio of diversified asset classes competing against a portfolio that is piled into just one asset class. And that's why we've got a much better max drawdown, a much better average drawdown, very much improved longest drawdowns here, and much improved volatility because by taking those uncorrelated sleeves of the larger market beyond just stocks and bonds, I've got pieces of that global market that move inversely to each other over time. So they compensate. When one's going down, another one's going up. And that's why you see the Sharpe ratio is so much better for the Atlas portfolio. And the beta is just 0.43, which means it's moving a lot less sensitively to the market overall than those total market funds are that Bogle would prefer. And see how effective Vanguard's marketing is here? I just called VT and VTI total market funds. And sure, I guess they are in a cap weighted sense for equities, but they aren't the whole market. There's just so much more than market cap weighted stocks and bonds out there. So that's the back test. But what about more recent history? Well, let's just go back as far as we can with AVGV because, well, we don't want to go the full way with a simulated return. So let's just substitute the LSV Global Value Fund because that's the closest one in methodology to Avantis's AVGV. And we're still going to extend CBYYX just for the time being and see how it lines up over the past, about 11 years. So right here, we can see that the Atlas portfolio is behaving pretty much as expected. I mean, it's right in line with the total world market. The total US market is way above, which is expected because the USA has done really great over the past decade or so. So yeah, I'm really happy with the Atlas portfolio and how it performed over this a very difficult decade for global equities and other asset classes when US large caps were dominating the field. And again, I'm not out to beat the market, I'm out to get a good return. I'm out to get a return that meets my needs. And you saw in the back test that the Atlas portfolio was bringing in about 11% compound annual growth rate. Look at what it's done over the past 11 years. It's right within its historical range of return, so it compounds reliably the same way during good and bad times. And its longest drawdown actually came during this specific period. So that's interesting to note. But yeah, I'm really happy with this portfolio design. The only drawback that I feel uncomfortable about with it is borrowing gold on top of US equities. If I could do global equities or a different strategy to borrow gold, I'd strongly consider that. But what if we just substitute the cat bond fund there with a fund that was running live? So now we've got all live sleeves on this Atlas portfolio. What what would that do? So Stone Ridge is also reinsurance and cat bonds. It's relatively unchanged here. Still compounding very very smoothly. So again, very pleased with its results here. If we just look at the live periods of our funds only, let's see how it's doing. Now, CBYYX is going to severely limit it, but let's take a look. So, yeah, it does great during a bad time. You can see that it kind of skips over those drops, but 3 years is perhaps a little too restricted. So, let's go with Stone Ridge. That gets us back to 3 years. AVGV is still the problem. It's really good that Avantis offered that strategy, but before that, LSV's global value portfolio was probably the only way to get it in a single ticker. But now going back 4.3 years to the inception of GDE, I mean, the Atlas portfolio is doing very well. It does what it's supposed to. It did well through the 2022 bear market. It skips over the dips, and it really gets its edge from capital retention during the bad times because I mean, it's great if you can make a greater return with all equities, but the question is, can you keep it during the downturns? And by expanding the universe of what is considered the market, the Atlas portfolio, by taking those uncorrelated slices from the whole market beyond just stocks and bonds, it just dominates because it can get those uncorrelated slices over a long period of time. Uh, it'll probably end up with about the same rate of return as an all equities portfolio, but at significantly reduced risk. Thank you again for watching Miller Momentum. I hope you enjoyed today's video. Don't forget to like and subscribe. What do you think of Jack Bogle's index fund philosophy? Let me know down in the comments. Any points you'd argue against me? Hey, I'd love to hear them, and hopefully I can give you a good response. We've got some exciting videos coming up, including a deep dive into and deconstruction of Vanguard's VFMO or Momentum Factor Index, and another video about the RISR or Riser ETF you won't want to miss. I'll catch you again very soon.